of course, it'll have different short-term effects. Like, okay, so if you own a short-term option on gold, maybe you'll make more money if there's a 50 basis point cut rather than a 25. I don't play that game. I don't care. And really, I don't suggest anybody should care because it's a dangerous game and it's just dopamine injections. And I don't want that in my brain. I want to stay calm. I want to stay level. So it's look, what's going to happen is there's gonna be an accident, and it's going to be serious. It's going to be like the apocalypse 5 years ago, or it's going to be something similar but slightly different. Whatever it's going to be, it's going to be. But it's a mathematical certainty because all of these institutions need trillions of dollars, and the amount of dollars that are available keeps shrinking. So eventually you hit a wall, and that wall causes a domino effect. So when that happens, whenever it does, probably after a reverse, sometime shortly after reverse repos fall to zero, then you're going to see a cut back down to zero in short-term rates. They're going to cut straight back down to zero, just like they did in 2020, just like they basically did in 2008. 2008 took a little bit longer, maybe. I don't know how many months exactly, but it was basically down to zero. This time it's going to be one cut to zero. And it's probably not even going to be a scheduled FOMC press release conference decision board, whatever. It's not going to be that. It's going to be in the middle of the night in an emergency meeting because of something that happened, and it's going to be sudden, and then the market's going to wake up the next day and understand that the Fed did this because of an emergency, and the stock prices are going to go all kinds of crazy, and gold's going to go even crazier, and silver crazier still.
In today's news recap, can Fed rate cut expectations sustain silver's uptrend? Silver prices rose, buoyed by growing expectations that the Federal Reserve may initiate interest rate cuts as early as next month. This optimism, coupled with ongoing geopolitical tensions in the Middle East, helped lift silver despite a stronger U.S. dollar. Investors also remained focused on a slew of U.S. economic data set for release this week. Silver's upward movement on Thursday was primarily driven by weaker U.S. Treasury yields and increasing speculation that the Federal Reserve will cut interest rates soon. In addition to Fed rate cut speculation, traders are closely watching several key U.S. economic data releases, initial jobless claims, and second quarter gross domestic product figures, followed by pending home sales data later in the day. These indicators will be scrutinized for further clues on the state of the U.S. economy and the likelihood of the Fed easing monetary policy. However, concerns over weak Chinese demand for silver continue to linger in the background. China is a significant consumer of silver, particularly in industrial applications. Sluggish demand from China could potentially weigh on silver prices in the long term, even as investors focus on U.S. economic data and Fed policy. The recent softness in Chinese economic data has raised concerns about the sustainability of silver's current price levels. The release of the PCE price index on Friday is particularly critical, although analysts doubt it will significantly alter market expectations for the Fed's policy direction unless it deviates substantially from forecasts. It remains a crucial data point for traders. Looking ahead, silver appears resilient, especially in a low interest rate environment where it becomes more attractive as a non-yielding asset. However, the metal could face short-term pressure if upcoming economic data dampens expectations for a rate cut. Additionally, persistent concerns over weak demand from China may cap gains in the longer term, especially if the Chinese economy continues to struggle. Despite the dollar's recent gains, which typically weigh on silver, the prospect of lower U.S. interest rates has kept investor sentiment positive. Now we'll show you the best clips of the latest interview, but first, subscribe, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
All the money that they're spending all over the place destroying things. There's a lot of collateral damage to the death of the dollar, and we're part of it because we spend them and we use them. But, we can adapt. We can adapt, and the U.S. government can't because that's their main resource supply, is the fact that the world accepts US dollars. But as for the gold market itself, it's pretty surprising that gold continues higher here, even though this is going to sound a little bit maybe heterodox or contradictory, but it's how things actually are supposed to work. Even though more money keeps entering the system, and the money supply is still much higher than it would otherwise be had the 2020 and 2021 printing not happened, which means that the stimulus effect should still be here. Even though we're at that stage, gold is still going up to new all-time record highs. I mean, it shouldn't be that way. The gold should really only be at all-time record highs immediately after an inflationary spurt, right? Not in the months and years afterwards when, the stocks start going up and other derivatives start going up. So money starts leaving gold, leaving the safe haven, chasing the momentum. But we're not seeing that now. We're seeing the momentum starting to die off, and gold hitting record highs. I mean, think about what happened in the last bull and then bear market. The bull market lasted until 2011, and there was a bear market in 2015. So you had this QE 1, 2, 3, right? And then gold hit record highs in 2011. And then we had like a 4-year bear market as money started to flow out of gold. There was less of a panic about the dollar, and then they went into these risk assets again. We had a little bit of that into 2022, but gold hit a low of like 1610 and then didn't go below that. So we're seeing sort of a repeat of we saw a little bit of a repeat of the 2011 to 2015 bear market, but it really wasn't much. It was especially, it was nothing compared to what we went through. I don't know if you were actively investing in gold back then in 2011 to 2015, but I was, and I was much younger. I had a lot less capital. I was just starting out, but I was still in an end game mentality. I was very naive, but I didn't know it could last this long. But I remember going through 2015 and like waking up nauseous and like realizing that my portfolio was like cut in half or even like 40% of what it once was. And I was trying to convince my wife, like, we were right. I'm right about this. We just have to get through it. And I got through it, thank God. But it was very difficult. This one, it wasn't much. Like, okay, 2022 went down to 1610. Okay, my portfolio is not doing so well, but whatever. It didn't really matter that much. So it's much easier this time. And we're gonna go much higher once the next inflation round starts, and we could talk about that too. But I'm pretty. Just bottom line, I'm pretty surprised we're at all-time highs in this situation right now. I thought we would be lower, and the fact that we're at all-time highs means we have a long way to go in the next inflation round.
In today's news recap, Bank of America expects declining silver inventories to make the deficits count. The Silver Institute shows that the silver market has been in a deficit for the last 5 years. And during that time, we've seen substantial decreases in global inventories, which makes sense, as the metal has to come from somewhere to meet the shortfall. Yet, with no resolution to the gap in sight, as the deficits are widely expected to continue years into the future, a recent Bank of America report suggests that the declining inventories are starting to make the deficits count. Their report also commented on China's surging silver consumption, which has continued to grow in 2024 as their solar production has again exceeded expectations. And with governments calling for a tripling of green energy by 2030, the demand for silver is going to have to increase if the governments are going to get anywhere even close to meeting their targets. China has already shifted to being a net importer of silver. And we've personally talked with one of the larger silver producers who told us about how Chinese smelters have been going directly to Latin American silver producers and offering substantially reduced treatment charges because they're able to take advantage of the increased premiums in China. Now, we'll show you more clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps.
The concept of a gold short squeeze. This can be construed as like a cheap subject, because people say short squeeze, and then we think of like Volkswagen, or that's the short squeeze that comes to mind now. That was like in the late 90s or something. These short squeezes where we like see a sudden vertical line as shorts close. Oh, we could talk about nickel, the nickel short squeeze. Um, and then people turn off and they say, "Oh, another gold bug's talking about a short squeeze. Never going to happen." I understand that. I get that point because theoretically, and this could be true. I mean, I'm not. I don't examine banks' balance sheets from the auditor perspective, so I don't know what they're actually lying about. But for every contract that a bullion bank is short in New York, they're supposed to be long a contract in London, right? They're not supposed to gamble on it. It's not that they're placing a bet on the price of gold, and a bank like JP Morgan is saying, "Well, I think gold's going to go down the next month, so I'm going to open a short contract." They're not. That's not what they're doing. They're called swaps, meaning they swap gold from New York to London. They go short in New York and they go long in London. And then if a client stands for delivery, they just deliver the gold or they do an exchange for physical from the position in New York to the position in London, and they're not really technically risking anything. However, so when we talk about short squeeze, why is it even worth talking about then? Because maybe they're not. we we don't really know what they're doing and who really owns the gold in London. And you can come up with all these theories on who owns what, but the fact is nobody really knows. Probably not even the bank knows. So what I'm basically talking about is that the amount of contracts net that the swaps, the ones that are supposed to be short in New York and long in London, supposed to be, they're record short. They have the record amount of contracts that they're selling short. Now, obviously, somebody has to sell short in order for somebody else to go long, right? You can't go long off of nothing. So somebody's got to sell the contract. So they sell the contract and they provide the liquidity in the market. That's what they're supposed to do. They're short like something like 250,000 contracts, maybe a little more. And that's what, like 2.25 million. What's 250 times 100? 250,000 times 100. That's 25 million ounces. Does that even exist in London? I don't think it does. So something's off here. And the fact that open interest went up last week, and it went up about 40,000 contracts, and the price of gold went up with it. That's normal. The price is supposed to go up with open interest. But at all-time highs, it means that the bullion banks are opening these new short contracts at the all-time highs. Now, if we're going to see a short squeeze, at least on the New York side, what we should see is falling open interest with a rising gold price. We almost never see that, which tells you that at least theoretically they are balanced. They're short New York, long London, because they're not pressured. So they wait for the price to fall, and then for people to either book their profits or whatever they're doing, and then they exchange the contracts. But if we did see one time falling open interest and a rising price, and that was into the 2011 top in September 2011. For about 2 or 3 months, we saw it. Falling open interest, rising gold price. We're not seeing that yet. If we start seeing that, then we can say it's a short squeeze. I don't know if that means they're going to default in London. I'm not making like apocalyptic predictions here to say that the monetary system is going to die on a short squeeze. I don't think so, because I think it's mostly a fiction. It's going to die in the streets, in the supermarkets in the United States. That's where it's going to die. That's where gold's going to go to infinity. But this could be a sign that we're going in that direction. So watch open interest. If the open interest goes down and price goes up, then we're on a New York size short squeeze. And what that does to the bullion banks, frankly, I don't really know.
What do you think of Rafi's analysis? Is he spot on, and do you agree with him? Post in the comments section your honest opinion and share your price prediction for silver going into year's end. Share this video with a gold bug and watch this video right here because it's a perfect fit for you. I'll see you on the other side.